happy Thursday, July 16th. Welcome to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going to the markets today, kind of interesting news on unemployment filings being higher than the economists expected. So there was a reaction there. All three ended in the red on that, down a little bit. Lost the momentum there on the wins that the S&P 500 and NASDAQ were having recently. Good news is crude oil still in the $40 barrel range today on that, and the U.S. 10-year Treasury yield also tightened more, shaved off a couple basis points, trading at 0.61 or 61 basis points today. So we are seeing a tightening there. And reactive to that are the single-family mortgage rates. Those 30-year rates dipped historically under the 3% number. That is incredible, quoting at 2.98 on the 30-year fixed rate single-family home mortgage. It's incredibly low, definitely an incredibly low interest rate, and a historic one to note today. Jumping on over to the FHA multifamily rates, the 223F is flat today. That is still quoting at 249. It's 2.49 fixed for 35 years. The 221 D4 came in a little bit. There's just a bit of a compression between the construction rates and the perm rates. So that came in a little bit at 309. That compressed about 5 basis points. So the 221 D4 is 309 and the F is 249. Jumping over to the agency desk, a little bit of a shave off there at about 278 today. Now, if that's a Fannie Mae loan with affordability in green and it's lower leverage, that could be as low as 275. And then over on Freddie Mac, mid-range 311, again with affordability, you can find a lower rate than that. That's not the lowest end of the spectrum for them, but that gives you a good indication of where they're at today. And speaking of rates, that's what I want to talk to you about today in other news. So being in this business and seeing rates every day and looking at them over years and years, in fact, even a decade or more, you really get a sense of for where we are in terms of timing in the debt markets. And this is certainly one of those historic, permanent, low interest rate environments that we're in. We did have one of these in the Great Recession as well, where there was a very significant drop. They don't hold forever, I guess is the point I want to make. And the other point I want to make to owners is that the debt, the fixed debt, if you're a longer term asset holder, I mean, if you're owning and flipping in a short amount of time, this is less significant for you. But if you're holding for 5, 7, 10 years or longer, or they're legacy assets, boy, that permanent debt, the interest expense is that one fixed cost you can actually control by locking it in. A lot of the other fixed costs that you might have are not, you cannot control. They will just, go up over time. But the cost of the interest expense, if it's fixed on a long term, that is a controllable cost. So I want to just check on the rates, kind of where we were before we reached this, recent ski slope of going down in rates. Well, on the 221 D4 FHA rate, we were at 450. It's 4.50. And on the 223F, we were at like the 390 range. So huge difference in today's world. It's not forever. So I just remind folks that when there's an advantage in the market, when there's a very strong dip like there is in the market, and you are a longer term holder, this is one of those times to really consider, how do you lower your fixed costs? How do you take advantage of a market such as this? And how do you really protect the future and the legacy of your portfolio as you move forward and as you maybe create a succession plan if that's part of your strategy. So those are my thoughts for today. Historic low rates, fix them when you can. They don't last forever. And I will see you here tomorrow for another exciting edition of Rate Desk. I'm your host, Michael Thomas, signing off.